Welcome back, everyone. Michael here with Offshore Citizen. I'm returning today with another interview. As I had mentioned in a previous one, if you guys didn't catch the previous example, this comes from an interview I did with Marco. So for those of you who didn't miss kind of the intro, very often when I have various different clients, etc., they become friends and we communicate on a bunch of things. And I'm somebody who's forever curious and trying to learn from other people as well as other sources, etc. And since they've done really well, I wanted to have some conversations with them about their investing philosophy. And so what follows is part of an interview that I did with Marco, who is one of the co-founders of Second Renaissance Capital, which is a fund that's done very well, and just me asking him about kind of some of his investment philosophies. They're a crypto-only fund, so they invest specifically in that, and they've got some very particular philosophies that happen to resonate well with me, kind of ideologically. So I like that, and just wanted to hear his position in terms of how he makes various different decisions. I think you're probably going to find, or what I found anyway, was that a bunch of the decisions were more based on getting the macro right and less about getting the details right, not really worrying so much about things like precise timing, etc., but rather trying to catch macro trends rather than small ones, which is on the one hand reassuring because it's something that I think is much easier to do. On the other hand, it's a little bit frustrating because it's harder to jump in the middle. This being said, I think it's still something really useful to be aware of, and so you can hear his details. If you're interested at all in talking to them about what it is that they do, you can send them an email. I'll put it in the links below. It's like inquiries@secondrenaissance.com, and you can go and check out, have a conversation with them. They have some really good material they've put out. That was one of the things when I was talking to Arthur, and we resonated a lot on this idea of just sharing great information. And so that allowed us to connect, etc. So I hope you enjoy it. I hope you find something of interest in there. It was, like I said, for me, something that I wanted to get clear and understand. And so enjoy the video, enjoy the interview. If you find that you have some points of feedback, give them to me. If you say, hey, listen, Michael, don't post these interviews, they suck. Well, I do have a couple more of them coming up, but then after that, I can listen to you and not do anymore. So I hope that helps. We will see you very soon on the next interview.
Cool. Well, maybe we can flip here into kind of an investing side of things. I believe you guys at Second Renaissance, and correct me if I'm wrong on this, took the view, because you're pure, well, let's start with, you're pure crypto, right? Nothing aside from crypto.
Yes.
And so what was the reasoning for saying, hey, listen, it's all crypto for you?
Well, I mean, this is where all the growth is at. And in terms of the return that you can make, I mean, I look at gold. Gold is the same price it was 10 years ago. I mean, that's not saying it will be a bad investment for the next 10 years, but what we're having here is like kind of a genesis cycle, like an inception of a whole new thing that starts from zero. It's like the internet when it first started, and we have like 2 decades of enormous growth, like orders of magnitude growth. And there is simply no other asset class where you can make several hundred times your money on individual positions. There's just in terms of investment, there's just nothing that comes even close. So that's why I, over the last 10 years, have become more and more involved, and eventually it has turned into my full-time obsession, right? Not just for money reasons, right? I mean, I could easily retire if I wanted to, but I like the space. I like what it stands for. I mentioned I'm an anarcho-capitalist. I want to see a free world. I want to be self-sovereign with my data, with my identity, with my money, and I'm pushing the space forward every which way I can.
Yeah, so I have my own thoughts on this question, but I'll just kind of throw back the things that people might ask, which is why crypto versus, say, angel investing in startups? Obviously, I think Google has done, whatever it was, 1 million X return or something from the initial seed round, something crazy like that. Mm-hmm. Why crypto versus investing in startups that are really small?
Yeah, you know, I mean, when I first had some decent money, I thought, okay, now I become this VC angel investor, right? And I made a bunch of investments that I thought were great, and either they're still illiquid like 10 years later, or they went to zero. And then I realized, wait a minute, to do that, I need many millions more, and I need to make like 100 of these bets to have like one or two that really work out, and a few that do well. It's just the bottom line is, you know, you're illiquid for a very long time, and if you invest in crypto tokens, you can get out at any moment. And the failure rate of startups is much higher, even if you do decent analysis. Then at least in my case, I'm much more capable of analyzing the winners in the blockchain ecosystem, and I've done very well with it, and it works out really well for myself and for our investors. Versus as an angel investor, I don't have the network. I at that time I also didn't have the capital to do it properly. And the key thing though is the liquidity, because something might take 20 years to get liquid. And do you want to wait 20 years? Probably not.
Yeah, that would have been the biggest thing that I would say. I've kind of reached this thesis over the last while is, you know, even if you could invest in a project and take equity, it's almost better to take tokens just because of the fact that you have that liquidity. I think when I think about it, I think of a few different things. One is a liquidity. Two is the fact that they are open source. You actually get quite a bit more data about what's going on. Like you can see how often they're updating GitHub repositories and things like this. So that's quite interesting to see. And then the third thing is, I think definitely the ability to get in with small amounts of capital is also attractive to a lot of people. You know, to go into angel rounds, you often have to put in a much more sizable investment, whereas you can put really low amounts into crypto.
And the other thing too is like the liquidity is super important, of course. But then on the other hand too, the upside of the tokens is usually much bigger than in equity. So, you know, there's very few Facebooks and Googles around in terms of the upside, but there are a lot of 100x, 200x, 300x tokens around, you know?
Yeah. I mean, there's a lot of 100x probably tech startups too. Something that went from 1 million to 100 million or something valuation wouldn't be that
True,
crazy.
yeah.
Let's
Yeah.
Yeah, interesting. So then within crypto, I believe you guys took the approach of focusing on protocols specifically. So you don't go
blockchains and protocols, yeah.
Yeah. And so what was the reasoning for focusing on blockchains and protocols as opposed to, I mean, there's a million things you can focus on in crypto out there.
Well, I always explain it with the blockchain ecosystem in its entirety. There are different layers to it if you look at it from an investment perspective, or how it all works together. So at the bottom, you basically have a hardware layer, you know, like the mining hardware, point of sale terminals, hardware wallets, all that kind of stuff. And it's a low margin commodity business. It's not interesting for investment, so you can discard that. Then you have the blockchain layer, which is like the foundation of everything, right? And then you have the protocol layer where you have more specialized protocols that do individual use cases or specialized technology. And then on the top layer, you have all the assets and all the applications. And the top layer over the long term will be the biggest one, simply because there's so many applications out there and so many assets. All the assets in the world, or almost all of them, will be hosted on blockchains eventually. So, but from an investment perspective, do you rather want to own like a share in one application? And so even if this one application becomes big, you have a big winner? Or do you want to own the blockchain that hosts 10,000 successful applications? And I just think the value will accrue to the blockchains and to the protocols over time. This is where you have the highest leverage point as an investor. And so for this thesis has worked out very well. And the other thesis that we had is that, okay, Ethereum has all these design limitations, all these constraints that make it problematic. It has a multi-year upgrade path that is questionable if it's successful the way they envision it. And meanwhile, there are other startup blockchains that basically already offer everything that Ethereum 2.0 is promising, and they have it already, and even more so. And so they're going to take away market share, and they're going to become big. That was another big thesis that we had, and that worked out perfectly. And that has been our strategy for the past 2 or 3 years.
Yeah. I think that that kind of makes sense. I think about it just as, you know, I think of smart contracts, and I think like, okay, over time, there will be at least 2 orders of magnitude more smart contracts than there are today. So somebody that value is going to go to, and it's just a question of where's that value going to go. If you get, you know, 2 orders of magnitude more, it's probably more like 3 or 4 orders of magnitude more smart contracts, but whatever.
And all these smart contracts pay their fee in the base token of the blockchain. So that's why you have there the highest leverage point where the most value accrues.
it's also a pretty hard thing to launch a blockchain as compared to, building a dApp is relatively simple compared to launching a new blockchain. So it makes sense that there are fewer projects.
That's another good point, because you have maybe 20 promising blockchains, and maybe, let's say, 10 of them do really well, and then 5 of them become super big. And so the probabilities that you pick some of the really big winners are much higher in that universe than, okay, here's some kind of DeFi marketplace, money market, whatever. There's like 50 or 100 of them, and there will be another few hundred. And what differentiates them? Basically almost nothing. So it's much more difficult to pick a winner there than at the base layer. And then in the protocols, it's even easier, because if you look at the database protocols, there may be just really 5 really good database protocols. So you pick like 2 that you think the best, and then the probabilities are extremely high that you have a big winner. So in terms of strategy, it just makes a whole lot of sense.
It's kind of interesting, now that I think about it, it's like the opposite of databases in real life. Like when you have databases in traditional technology, not much value accumulates there, because usually the database is open source. You have something like MySQL or whatever that people are using, and the value all goes to the applications using that technology. It's kind of the opposite here, because it's not really just a database; it's a database and infrastructure pairing, right? You have all these node operators who are running that database, and so you're betting on that underlying ecosystem more than anything else.
Yeah, it's true, but that's one of the key things with the economic incentives in the blockchain ecosystem, that almost every protocol or service has a token, and therefore has this effect of having the monetary incentives to like if the project is successful and grows and it's getting used, and then you have the token that makes the whole thing work, that ties it all together, that makes it secure. The token goes up in value as the project becomes more successful, and then you can now pick and choose your playing field where you think you have an edge, or where you think the most value accrues, and place your bets accordingly, and have a very good chance of this working out very well for you.
Yeah, absolutely. Cool. And so when you mentioned that you, as a firm, focused on blockchains and protocols, what's an example of a protocol that's not a blockchain, and how you define protocols in this case?
Well, a database is an optimum example, because everything that is digital has some sort of database behind it. So the database space is one. You mentioned earlier interoperability. There are protocols that specialize in moving assets from one blockchain to another, or passing information from one blockchain to another. And there's like many specialized use cases. File storage is another one. So they're just basically foundational building blocks, let's say, to make all these apps and all these applications work, to enable all these services. You need certain building blocks, and there are these protocols that specialize in just one function.
So would you include something like Chainlink in an example of protocols, or?
Yeah, absolutely. I mean, Oracle services are very important. Now, what's an Oracle? An Oracle is basically, you take a data source that is not coming from a blockchain, somewhere else from the web, and you need this data, and you need to present this in a secure and verifiable way to a smart contract to be used within the blockchain ecosystem. So that's a very important element. We need many data oracles for many different things, and so that's a perfect example of a specialized protocol that just focuses on bringing data from outside the blockchain ecosystem within it in a secure way, so you can be used from applications in the blockchain ecosystem.
And would you consider something like lending protocols like Aave or Compound to be a protocol as well in this, or not so much?
Well, I mean, there are protocols that basically just enable the function of being like a money market, and then you can build different applications on top of it. And then there are others that are just an application itself. So you have to, in this case, look at more specifically what it actually is. And there are both. So
Yeah, it seems to me like what I've noticed is with blockchains, there's certain building blocks that they seem to need in order to develop an ecosystem, right? And so like a lending protocol is one of those building blocks, as an exchange is one of those building blocks. Liquidity pools and things like this are, kind of foundational pieces that then they kind of can build from there into something else.
Yeah, so one way to look at it is, for example, with an exchange, like, can you only use that exchange to trade on that? Or is it like a modular system where you can build your own front end, or you can integrate this exchange into your own application? And then it's more like a protocol thing that will have many exchange apps built on top of it, and then it will accrue a lot of value versus just having one exchange. And of course, if that exchange grows, then you benefit from there, but it's still just one exchange.
Yeah, yeah. What are your thoughts on something like Theta?
I mean, the video space, all this video transcoding, video hosting, and so is obviously big. I mean, YouTube is the second biggest search engine in the world and has probably replaced television for a lot of the younger generations.
Oh, you suddenly became quiet on me there. I can't hear you.
Oops, muted myself there by accident. The video space is obviously huge. And so there's a lot of potential there, but it's not a space that I have looked at in detail. So I know that Theta is one of the big protocols there. LivePeer is another one, but I'm not an expert in this niche.
And you mentioned earlier Arweave. Have you looked much at that?
I'm a big fan of it because it's the dominant protocol in its niche, which is permanent storage. So you have just file hosting that can basically disappear at any moment, right? If you're like using Dropbox or something like that, you're backing up your files, or something like the Google Cloud where you just host something. But permanence is a very important issue. Like we mentioned earlier about the blockchains getting huge and they need to be stored somewhere. A lot of protocols are using Arweave because their selling point is like you pay, but you pay for like 100 years of storage, and it's decentralized and it's replicated many times. So it's guaranteed available for 100 years. And that's also like for something like the Wayback Machine, like within, I don't know the exact number, but within a certain number of months, like a significant percentage of all the links on the internet are broken because the data is simply no longer there. And Wayback Machine is like a non-profit that is archiving the entire internet. And so they, for example, are a perfect use case for something like Arweave, where you can just upload all the stuff there and it will be available for everyone or anyone forever.
How does it work from a business model standpoint? Like, it seems really terrible to like have something permanently, because obviously it's reliant on infrastructure, and the infrastructure has ongoing costs over that 100 years. And how does that work?
And that's why they have structured the incentives accordingly, that you get paid out in a stream and the payment gets trickled out to you over time. So they make sure that the data is replicated enough times over that time frame.
Interesting. Yeah, it's something, I've got some clients and friends who have invested in it. I have some Arweave, but I haven't gone aggressively into it. And it was one of these ones that it didn't quite make sense to me, and I haven't had a chance to dive into reading their white paper or something like that. So that's interesting.
I mean, that's really the core issue, is like you come across so many good things, but do you have the time to properly analyze it? I mean, for me, it's my full-time job. I 24/7, I live and breathe crypto. And even though I specialize on the segments that I focus on, it's really tough to keep up. And that's why for the average person, they're much better off like reading a high quality investment newsletter that analyzes the stuff, or investing in a fund that specializes in that, than trying to do it themselves.
So one of the things I'd like to talk to you about a little bit is the cycle. I believe you guys have a target of buying within 20% of the bottom and selling within 20% of the top. Is that accurate?
Well, I mean, the closer you get to the bottom and the closer you get to the top, the better, obviously. But here's the thing. The cycles in crypto are about 4 years. And if you buy early, and buying early is much easier than selling the top, because the bottom formation takes a long time. Selling at the top is much more challenging, because the peak can be like, just we're talking about a week or a few days or so. So where something from an already high level then doubles again, but then within a few days starts dropping. So to time that exactly is much more difficult, but you don't need to time it perfectly if you're in the market for the length of the cycle, because then you're already sitting on really massive gains, and to eke out this extra little bit is not really necessary. Of course, we try to get as close to the bottom and to the top as possible. And in terms of strategy, the way you do that is, of course, we have a lot of like institutional research that we can access to. We're connected in the ecosystem. We have our finger on the pulse. So we have a really good idea when we're relatively close to the top. But nobody, of course, can predict the top exactly. So the way you do it is you scale out in multiple tranches, and then you sell higher and higher and higher, and in the end you have a really high average. And if you do it right, then you're somewhere within that range that you mentioned.
Okay, interesting. Yeah, so a few questions here. The stereotype is the 4-year cycle, which I think is the story is that it's around the Bitcoin halving. I famously have been saying for a while that I think that's probably a case of fooled by randomness. I don't know that I'm sure that that's going to continue. What do you think that we're going to continue with 4-year cycles? I think that you said
no.
No.
I mean, You're right. I mean, 3 or 4 cycles are not statistically relevant, but they are a precedent that has worked out until now. But if you analyze this data in detail, you see that over the last 2 cycles, they have already been lengthening. And I think this will continue because as the asset class matures, the volatility will go down and the cycles will lengthen. And so we're already seeing this happening. So like you said, it's not statistically guaranteed, but it's a high probability that this is what's happening. So we have this more or less 4-year cycle. Now it's probably a little bit longer where things go up a lot, an order of magnitude or even more, and then they drop a lot. Now in the past, it dropped like 80-90%. Now that the asset class has reached multiple trillions, probably we're not going to drop 90% again. Maybe we're just dropping 60 or 70%. Nonetheless, of course, you don't want to be there for a 70% drop. That's why you sell at the top.
Sure, absolutely. Yeah, I mean, look, a lot of things were down. Like Avalanche was down 80% from its high earlier in the year till whenever it was, bottomed in May or June or whatever. So even there was an 80% drawdown from
even there. But the good thing is about these correction within the cycle, then we're looking at like 1 or 2 months, in some cases even just 1 or 2 weeks, where things then start trending higher again. But once the 4-year cycle reaches a top, then you'll probably have a year or 2 years of decreasing prices and then lots of sideways action. So that's the one you really want to time.
So where would you consider the cycle to have started this time? Like, I mean, you could argue, I guess Bitcoin bottomed in 2019, but then we had March 2020 where we had this somewhat anomaly where it went almost down to the previous lows. What are you guys looking at in terms of where we are in the cycle today and where it kind of started when you're thinking from that standpoint?
I mean, the starting point, I would say, is after the December 2017 top. We dropped, right? And wherever was the lowest point, I'm not even sure where exactly it was. So that would be like then the bottom, and then after that starts the new cycle.
You guys had,
but then of course you can, but then of
ahead.
course you can also look at it from a halving perspective and analyze everything based on the halving. So there's many different ways of defining it, and you know, a lot of technical analysis is also like more voodoo than science. So it can be a good indicator, but I wouldn't rely on it. You know, you have to be a macro big picture thinker, and you have to see, okay, blockchain ecosystem, the whole crypto space is probably in a bull market for another 1 or 2 decades. Within that, we have these larger cycles of about 4 years, and it doesn't matter if it's 3.5 or 5 years. You know, you just got to get it roughly right, and you're doing really, really well. And then the smaller the time frame, the more we get to the voodoo level, right? So and the less reliable it becomes. And it's also from a, you know, for me as a speculator, it's much easier and it's much less work to just like, okay, identify a bottom. Okay, now we're really low. Now I buy it, and now I wait until it goes really high. And in between, I have to do nothing, right? As a day trader, I'm nonstop in front of my screen, and it burns you out, and it's really stressful. I don't want to do that.
Yeah, totally. So how do you guys decide when is a good time to get in?
Well, I mean, that's easy to identify because you have these big bubbles that pop like in late 2017, and then you're down 80-90%. So you could say, okay, maybe I bought too early, and at minus 70%, I bought already and didn't wait for like a more sideways action, more classical bottom formation, or you wait until this really plays out and slowly starts rising again. So yeah, that's a matter of like difference, say 20-30%, but if you're in the cycle for the whole duration, then it's not really making a big difference. So
and is your strategy to layer in just like you layer out?
I mean, at the bottom, it's much easier to just deploy the capital right away because like I mentioned earlier, you know, a bottom goes usually sideways for quite some time when it has actually bottomed out. So it's not a matter of like quickly identifying it, and it will not move quickly. So you can deploy your capital right away. If you're in a more volatile situation where you're not really sure, then you got to be more strategic. But if you're clearly aware of that you're in a bottom, and maybe you're still going sideways for much longer, but it's unlikely that it drops further, and it's unlikely there will be a lot of volatility at the bottom, then you might as well deploy your capital right away.
Yeah, I was thinking mainly like, you know, it goes down 70%. So you're like, well, you know, it's pretty low. So, you know, but it could still go down to 80%, or it could, you know, and so do you start accumulating because you're not sure, well, you know, this could be the bottom or not, or do you hang on and, you know, do you scale in, et cetera? I guess that was kind of the reason for asking.
Yeah, I mean, honestly, you can scale in, you can deploy everything, you can be a little bit early, you can be a little bit late. If you get it roughly right, it's not going to make a huge difference.
Yeah, makes sense. Makes sense. And then how do you guys look at because like I look at, for example, Avalanche, right? So Avalanche, I don't know when the person could have bought in, but it went up really high in, was it January, February, something like that? I think it peaked around like $64 or something. And then the whole market was doing pretty well for a period of time, but Avalanche came down a bunch and didn't have another run up until like the last little bit here, where it kind of exceeded that previous high, et cetera. So do you think that everything is likely to kind of peak at the same time, or you think some things are likely to peak and then kind of fade and then others peak and so on, as you kind of come into the end of the cycle?
It depends on your time frame. So in the big picture, it's all roughly the same, but it might be that, let's say, Bitcoin peaks first and then the smaller projects peak like a month later. So it really depends on your time frame. They're probably not all going to peak exactly at the same time, but I'm also always somebody that says this concept of Bitcoin and altcoins is really outdated, because every project in the end lives and dies on its own merit. And yeah, the whole sector, of course, moves broadly together on a cycle, but you really got to look at each project individually. And then what you talked about with these corrections is something like Avalanche came from nothing and had a huge run up. And so it's only normal, that's the way markets work, that some of these gains they're giving back, there's a correction, then there's usually a sideways action where this new level gets consolidated, and the longer this goes sideways, the bigger then the next breakout will be. And depending on where we're in the market cycle, it can be a breakout higher or breakout lower, but we're still in the bull market. So now we have some sideways consolidation, so there will be then the next breakout, and then where it explodes higher again to a much higher level. So that's just how markets work.
And yeah, makes sense. So when you're doing this, do you apply any sort of like valuation metrics to your analysis?
It's very hard to do that if you compare it to the stock market, where you have a price earnings ratio, where everything is much more established and clearly defined. In crypto, it's much more relative, because if you believe that Avalanche, for example, will be the dominant blockchain 10 years from now, and all stocks, bonds, whatever is hosted on it, what value do you put on it, and where is it now? So it's all relative also within the blockchain ecosystem. You look at something that I think nothing of, like Cardano, which is valued at almost 70 billion or something, and you have like a project that I think will be a leader that is like a fraction of that. So you have to see where you are within the cycle. You have to see where you are relatively within other things. And in terms of fundamental value, is like there's not really so much to work with yet, because the whole space is still so nascent that it's very difficult to apply like more traditional metrics.
So for you, basically, you're trying to find good projects and do the analysis of saying, okay, this one's likely to be a winner, this one has a key niche, et cetera, and then buy it at a low stage in the cycle and hold it to a late stage in the cycle. Is that kind of the strategy of the fund?
Yeah, we want to buy future leaders in their segment early in the cycle, hold them over the duration of the cycle, sell them relatively close to the top, and do that with a diversified portfolio of about 20%. Because then you have broad enough diversification that you're basically guaranteed, if you do a good job, to have a handful or 3 or 4 really big winners that drive basically all the returns. You have a broad middle where you make a few 100%, decent, but nothing crazy. And you have a couple of losers because nobody picks all the winners, right? But because you have only a diversification of 20 positions, this individual allocation of 5% each, if I have 5% in something and it goes 500x, then I have spectacular returns. And if I have that with 2 or 3 positions, so that's basically how our strategy works, and that's a strategy that served me very well over the years, and it's serving our investors in the fund right now really well. It's looking really good for this cycle.
Yeah. No, you guys did well. So with respect to thinking about that, then what happens if people come into the fund later, and then you kind of have to obviously allocate their capital somewhere? How does that work?
I mean, over time, your portfolio gets more concentrated in the winners naturally. And of course, if somebody gets in the fund or in the market later, then of course they cannot expect the 100, 500x anymore. If you come in now into the market, if things go really well, maybe you get a 5x still. Most likely you'll get a 2 or 3x for sure. So it's still very, very competitive. But that's also the reason why we're closing our fund in 2 weeks, because we're now late enough in the cycle that, yeah, if somebody comes in now, we can still probably 3x, 5x their capital. But beyond that, then the risk reward becomes more murky, and it's not really that attractive anymore. So that's why we're closing the fund in 2 weeks. But then even if you're only getting now and you double or triple your money, it's great. And then there's the next cycle afterwards, and then you can be along for the ride for another 100x or more, you know? So that's the beauty of it. We're still so early. I mean, there's a few million people using this thing, and we have billions of people and ready to or still waiting to get in. And so we'll have at least 2 or 3 more big cycles after that. So it's still relatively early in the big picture of things.
Yeah. So then when you're thinking though about allocating capital today, and I mean, I guess this is relevant to anyone who isn't allocated today, how do you then decide, like, you know, it's all well and good to say, all right, you backed up the truck in 2019 and early 2020 or something and got a lot of allocations at good prices and great projects. But today, how do you make the decisions about where to allocate that money now? Do you just kind of diversify it across the same projects, or do you pay attention to the current valuations and price, or how do you make that decision?
I mean, I would still run a diversified portfolio because any single project can have problems. But at this stage in the cycle, you can definitely concentrate a little bit more on your winners, because one thing is true in markets, and that's winners usually keep winning. So if you have identified the winners, it makes sense to focus more on them, but you still don't want to over concentrate. So at this stage, you wouldn't start with a portfolio of 20 projects. You maybe start only with 10 and put more emphasis on the ones that you have identified as winners already.
Okay, so basically, and this is, I think, an interesting perspective, because one perspective is you can say, okay, something is lagging, and so I should buy into it because it's lagging, so it has more upside. You're saying kind of the opposite. You're saying the things that have run up probably are going to continue to run up, and therefore you should allocate your capital there.
It depends on why it's lagging. You know, there might be projects that are great and doing everything right, and they just haven't gotten the attention of the market yet. And that's why I'm saying not just buy three top blockchains, but still have a diversified portfolio of 10 and have some of these laggards in there, but they have to lag for the right reasons. You know, if you look at Phantom, for example, they got no attention at all for years, and all of a sudden the market woke up to its potential, and then boom, it went to the moon, as we say in the crypto space.
Yeah.
But if something lags because it's crappy and the team doesn't do anything, and it's not gaining any momentum, then of course you don't want to buy in this kind of laggers.
Yeah, that definitely makes sense. And in terms of some of these, do you pay attention to signs that they might just be super overheated? And so even though you think, hey, we're not at the end of the cycle, you're going to sell anyway because it's just so incredibly overpriced?
It's very easy to underestimate how crazy the market can get, especially in the last third of the market when we're in the mania phase. I mean, when you as a rational capital allocator think, okay, now we're already like at crazy levels, then it will probably double and triple again, right? So the mania phase can surprise anyone because it's completely irrational, right? And that's why you can not put any real good analysis on it. And it's an art and a science to get this right? But if we're still I think we still have several months to run in this market. So even if something on a relative basis looks overvalued right now, I wouldn't sell it, because I think at the end of the cycle, it will be much higher still.
Okay. So yeah, like when I look at it, usually my basic approach is to try and reason by analogy and take a look and say, okay, great. For instance, Solana can't be bigger than Ethereum. If it was, then I would be concerned that it was overpriced at this stage. It's just the adoption just isn't there. Over 5 years, sure, maybe. But at this point in time, that would be like a reasoning by analogy to me to say, hey, this makes no sense. Now, to be fair, I would never put Dogecoin at 70 billion. I wouldn't even put it at 7 billion. So, you know, I'm clearly wrong in these senses. But that would normally be how I would kind of like process it, is from the perspective of valuation. So yeah, it is true though. Like a lot of these can, however high you think it can go a lot higher. So that's sensible. What are your thoughts in terms of regulation and the threat that poses to the crypto space, in particular in the next, I don't know, probably in the next year or 2 years?
I think it's most people pay too much attention to that, because it might be a temporary speed bump for the market overall, and it might be a significant problem locally. But we're talking about a global free sovereign market that is permissionless and censorship resistant. So it's one of these things that this new technology is out, and now it's growing and developing, and nobody can stop it. Of course, a strong government, like say something authoritarian like in China, yeah, of course, they can do a lot of damage to the Chinese market, but they cannot shut it down globally. So if there is a negative sentiment because there's a lot of negative regulatory action, it can definitely be a speed bump overall for the market, but nothing will prevent the rise of the blockchain ecosystem. You know, this is going to happen, and it's just a question if are you on board for this ride or not.
Are there particular types of projects or companies or something that you feel are more open to market regulation, et cetera, more at risk of that?
Yeah, of course, if you're like, unfortunately, you know, the US was always like a pro-tech company, and now they're turning into the country. Now they're turning kind of in the opposite. So if you're as a team exclusively based in the US and just sitting in an office in Silicon Valley or something, and there's some crackdown, and I mean the US, the IRS things like you're making capital gain, the SEC things you have a security, the CFTC things you have a commodity. Like every regulatory agency in the US wants to get their piece, and it's all in a negative, coming from a negative point in the US. So there might be some big crackdown in some way that will really hurt your project if you're just based in the US. On the other hand, if you have a project that is all anonymous founders, it's completely decentralized, nobody knows who's behind it, it's a decentralized project, it has no attack surface, like what are you going to do? It's simply going to grow and thrive.
Yeah. Yeah, I tend to also think that anyone who's a custodian of some sort is more at risk, like stable coins. I could see them going after those quite a bit. Exchanges, of course, can get more attack. Lending platforms can, these are
it's like with anything, the devil is in the details, and you have to take a differentiated view on it. There some areas are at risk, others don't, but you can't really make a blanket statement on that.
Yeah. What's your position on, because you're mentioning your winners and your losers, what is your approach to basically deciding, hey, I was wrong about this and I should remove my position and reallocate the capital somewhere else?
Well, that happens occasionally too, and it's just a matter of keeping up to date with the project. And if it's not going where you think it's going in terms of the adoption, the growth in terms of the valuation, the growth in terms of the developer adoption, the community adoption, like at some point you got to see, okay, what is wrong here? Is this just a delay because of X, or is the team just not executing the way I expected, or is my thesis wrong and the market is going in a different direction? And usually it's a combination of all these things. And at some point you got to say, okay, my capital is now better deployed in another project, and I cut this loss and redeploy elsewhere.
As a money manager, how do you avoid getting emotional? And this is the classic problem, right? Is that you can.
I'm not sure if you can really train that. I mean, either you have like a personality and character traits that lend yourself to doing a good job with that and looking at this in a detached, cool manner and approaching it rationally, or you don't. I mean, I don't know, maybe you can learn and train that. I mean, for me, it's always been easy to be detached from that. And even if all of a sudden you get really wealthy, now you're dealing with much bigger numbers, but in the end, it's just a couple extra zeros on the screen. So nothing really changes, right? So yeah, it's a matter of personality, I guess.
One thing I definitely find is really interesting in the crypto space in general is I notice a lot of people who have made quite a lot of money very quickly, and their attitude towards money seems quite different than people who come from more traditional industries having made money. And maybe it's something about kind of the easy come, easy go, but it's like you can see swings of millions of dollars in a day, and it's like, oh yeah, it's all right. Just very,
yeah, I mean,
very interesting.
I guess in that sense, it is conditioning, because I mean, in my case, I've been in this market for over 10 years, and this extreme volatility, I'm used to it. So if something swings that extreme, I'm numb to it already. Of course, if you're not used to that and you experience that for the first time with an amount that is significant to you, then it can get very stressful very quickly, I assume.
Yeah, you can see your net worth cut in half in a few days, and
yeah,
like,
not a pleasant experience. Michael, I got to wrap it up in about 5 minutes or so.
No problem, no problem. Well, I appreciate you answering the questions and filling us in. Let me see if there's anything else I want to ask you about just before we cut it off. I think that's probably it. So it's probably good timing. So I appreciate you taking the time to share with us. If anyone wants, they can, I guess, also check out your website, Second Renaissance. And
yeah, so if you're curious about crypto and you want to get involved, there are multiple ways. I have a video course for beginners that explains all the fundamentals, all the basics. It's called Crypto Quantum Leap. And then for the retail do-it-yourself investors, I write a crypto investment newsletter that's called Project Serenity. You can find both of these on my website at marcowutzer.com. And then, of course, for the high net worth individuals that want somebody to have their money professionally managed for them, we have our fund, Second Renaissance Investments. Like I mentioned earlier, we're closing it in 2 weeks. So if you're interested, get in touch at inquiries@secondrenaissance.com and we can hook you up. And yeah, that's about it.
Cool. Well, yeah, always interesting to hear different investment theses, especially since you guys have done really well. So thanks for coming and sharing your perspectives, and we'll look forward to talking soon.
My pleasure. Talk to you soon, Michael.
Awesome.